This is Fonder Direkt. Today we have East Capital with us. I'm happy to welcome fund manager Dmitriy Vlasov to the studio. Welcome.
Oh, thank you. It's nice to be here.
And you're a fund manager at East Capital. Can you tell us a bit which fund do you manage and what's your strategy?
Yes, exactly. Well, I've been working with East Capital over the past 11 years. Over the last 7 years, I have been working with the China shares, China equities, and specifically China A-shares funds.
And what are those? What are A-shares?
Well, the A-shares, this is what we call the domestic market shares. There's two stock exchanges in China, Shanghai, Shenzhen, and the shares that are listed, the domestic shares that are listed in those two stock exchanges, we call them A-shares.
Okay, and what are the alternatives then?
Well, this is really a big market because if you look at the market cap of the A-shares right now, after the market is down so much this year, the market cap is like $6.5 trillion US. So that would be one of the largest market in the world. We have a big number of companies trading in these two stock exchanges, 3,600 companies. I think what makes this market interesting, it's the structure of the market, because you still have a lot of retail investors that trade at the market. 70-80% of all the trading is done by the retail investors. You don't have many foreign institutional investors in this market yet. And this market has a fairly large share of inefficiency, so to speak, which makes it very interesting for active portfolio managers.
Oh, all right. So the inefficiency it's a good thing. That's where you find your arbitrage, your winnings.
Well, definitely, inefficiency can be a very good thing if you know how to take advantage of this inefficiency. I think the inefficiency in the in the A-share market, it's mostly because of the structure of the market, i.e., mostly retail investors, and B, because the coverage of the stocks is not as good as in some other more developed markets. So it's
an immature market almost?
This is still immature market. Yeah, that's correct. So it is indeed.
Right. Let's talk about your biggest weight in the portfolio. It's an insurance company. It's called Ping, I think. And it constitutes 10% of the weight of your portfolio. Can you elaborate on why that's such a good investment? Is it market inefficiencies?
Well, the company is called Ping An Insurance Group.
Okay, I'm sorry.
Actually, and most of its operations coming from the insurance business, but it also has a bank, retail-focused bank. It also has a fintech exposure with its fintech portfolio holdings. I think in general, insurance sector has been very interesting for us. I think we see the rapid development of the industry over the past several years as the per capita income, hitting this level when people start thinking about insurance. At the same time, if you look at the market, it's still the penetration of the insurance product is still very low. We think it's around 2.5–3%, and if you compare it to more developed Asian countries, like Korea, Japan, Taiwan, there you have 15–17%. So we have a long-term growth trajectory there, and we have
why is that? Who's buying the insurance?
Well, it's individuals, households. They hit this level in terms of their income that they think about protection and long-term preservation of capital. And insurance insurance companies, they offer a number of interesting products to meet these requirements.
And they didn't have to have insurance before because they didn't have that much capital to insure. So when their capital increases, when they get more money, they need more insurance.
I think that's logical. As the per capita income grows, then the allocation to the protection and life savings products, life savings insurance policies, it increases, and that's what we have experienced in the Chinese market starting several years ago, when the incomes hit the critical thresholds. For the insurance business to really start growing.
But isn't there still a risk? If we go back to that you have such a big investment into this company, how diversified are you? How many holdings do you have?
Well, in general, the way we have been managing this fund, this strategy for about 5 years now, and if you look at the number of holdings, it's between 30 and 40. I think right now we have 32 positions, fairly concentrated, but that's because a number of stocks that we like to invest, where we see favorable risk rewards, they came down so much because of the sell-off this year to date. So that's why we are a little bit concentrated. But 30, it's quite good level of diversification.
And what about your ESG approach? I know that's something that you value highly. Can you walk me through your approach when you pick your stocks?
Well, at East Capital, we have developed over the years proprietary ESG framework we call the ESG scorecards. So what it is, essentially, we rank every company based on a number of ESG criteria. And for the company to be in the portfolio with a significant weight, it has to meet a threshold, minimum threshold in terms of the ESG scores. So, and that's what we are doing.
And this insurance group has a really high ESG
well,
threshold.
It has enough, in order to take that much weight. Yes, indeed.
Let's talk about a wider scope, larger economy. There's been a lot of trade tensions in the world, and a lot of it has been focused between China and between the US. Do you think the media is proportionate to the risk that this adds to the market?
Well, trade frictions is just one part of the story. I think if you look back just last year, I think it was perfect time for China economy. We had GDP growing up. We had favorable external environment. We had a number of issues, long-term structural issues being tackled by the Chinese government. Earnings were great. Then the market, on top of good earnings, the market re-rated. I think in 2019, the market is down. I think A-shares is one of the worst performing markets globally. And there are a few reasons. I think the trade frictions is just one of the reasons. Another reason is, on the back of a very strong year last year, Chinese government moved very aggressively in order to tackle long-term structural problem, too much debt, too quickly growing debt. So they were, very aggressively deleveraging earlier this year. But the timing was wrong, and then the geopolitical tensions came in. So that actually deleveraging impacted, the real operations of the companies. We saw that the companies reported increases in the financial costs. There was no way to get access to financing, to the bond market. So in the middle of this year, sometime July, August, Chinese government realized that it's not the right timing to be as aggressive in terms of addressing the leverage problem. So they started slowing down on this side and adding a little bit stimulus, letting companies access a bond market. So that's getting better. But the trade friction, it's interesting because if you just look at the tariffs, I think they clearly wouldn't justify such a big impact in terms of the market decline. Because we looked at the numbers, and by our estimates, even if you have tariffs on China goods, the impact on the GDP, it wouldn't be that big. I mean, we are talking
it's quite small.
Yeah, between 50 basis points to 80 basis points, depending what kind of assumptions you put there. But it certainly would be manageable. But I think the problem here that many people view the tariff is just the first step towards something that no one knows exactly what it is. So obviously, the trade frictions, many people interpret those as, it's just the beginning.
Protectionistic agenda. During the year, a number of countries have urged their teleoperators not to use Chinese appliances in telecommunications due to a risk of cyber attacks and information leaks that are spurred by the Chinese government. Do you think this, the way that the Chinese government can influence this business, is that a problem?
I think that's a very interesting question because I think what we need to differentiate here the real risks and the perceived fears. So because right now there is a lot of fears. They don't have the real basis for that. It's the fear of eavesdropping, the fear of suddenly Chinese government decided to stop the network. Many others. I think Huawei got to the point, and you're probably asking mostly related to the Huawei and the recent situation, because they had something to offer to their clients. They're at the forefront of the 5G development. They are very flexible in dealing with their customers. They're one of the. They have 80,000 R&D engineers actually, working on this. So that's how they got there. It's not necessarily just because of the of the help of the Chinese government. I think the second thing that I wanted to highlight, at least Huawei, they claim that they are a private company, so and have no relationship to the state. So this company is not publicly traded, so it's the level of disclosure is not sufficient enough to either reject or take this statement. But I think if you look at the bigger issue here, the Chinese government involvement in parts of the economy, I think this is happening. This is one of the risks when investing in the China market.
I think it's one of the biggest fears from the Western viewpoint.
Well, this is the risk, and you can look at the source of this because China is still centrally planned economy, so the government sets the target, and then the government in the end is responsible for the parts of the economy to hit this target. So by definition, given the structure of the economy, you will expect much bigger involvement of the governments in the aspects of the economy. We also have a number of a bigger number of state-owned enterprises where the government has a stake. And obviously is interested in these companies functioning properly and delivering necessary results. So yes, by default you have much bigger government involvement.
Do you think this government involvement needs to be reduced in order to make the markets merge with each other?
Well, I think it's a very good question. In general, privately owned businesses they are better in terms of growth, in terms of returns, and I think in general the government it would be better if the government has less involvement in the economy as it has right now.
And let me ask before we close out this interview, what's your outlook for 2019 about Chinese equities?
Well, it's been one of the worst years for the A shares this year. So as I said earlier, the market is down, significantly. Recently I looked at the numbers; it was down to more than 25% in US dollars. So quite a big drop. But then, if you look at the next year, I think a lot of factors that contributed to negative performance, they have a chance to reverse themselves. For example, clearly the deleveraging is not at the top of the agenda compared to the beginning of the year. As a matter of fact, if you look at the interest rates, they have declined quite a lot recently. At the beginning of the year, 10-year, treasury bonds were at more than 4%. Now it's 3.4%. So this is positive. Then progress with on the trade frictions with the U.S. administration. Just last weekend, we had a very good meeting between Xi Jinping and Donald Trump, where they agreed on a roadmap to resolve the trade issues. I think China is committed to doing this, and obviously, Do
you think the U.S. is committed as well? I mean,
I think it was
a positive sign, but
no. But I think it would be good at this point of time. It would be good for both sides if we can at least de-escalate tensions on this side. And I think then you need to look at Asia-specific catalysts for the next year. The big one is the MSCI inclusion. You may have heard that this year MSCI included the first phase of the A shares in its emerging market index. It's not a big weight, only 0.8%, but the inclusion factor for this first phase was only 5%. Now MSCI is proposing to increase this to 20%. I think they will announce or planning to announce their decision by the end of February 2019.
So what does that mean for a typical investor? That they can invest in Chinese stocks easier, or? Well,
what it means is that they're, because MSCI Emerging Market Index and other indices are followed closely by active portfolio managers and passive ETFs. So now they would have to allocate much more to the A shares, I think. And that would bring additional flows to the market. Not only this, because when the foreign capital would enter the A-share market, it also would contribute to institutionalizing the market even further. So that's what the market needs. It needs long-term capital, institutional capital, which is currently lacking. Yeah. Because in the A-shares right now, most of the capital is retail focused. That is very sentiment-driven and volatile. The good thing is local capital. The bad thing it's it's mostly retail.
So do you think the market will become less inefficient? We were talking about inefficiencies before.
Over time, it would become less inefficient, but it would take time for the A-shares to become, a big part of the portfolios of the global investors. In the case of Korea, Taiwan, that went through the same process, it took between 6 and 9 years in 90s, but there were significant changes to the structure of the market. And the last thing about next year outlook is the valuation. Yes, there have been a lot of issues, but now if you look at the price to earning multiple, it's very close to the trough level. So it's trading at less than 10 times earnings for the next year, which is a very interesting level.
So do you position yourself for that in your fund?
Well,
is this the time to buy?
We have been managing the A-shares, as I said, since the end of 2013. Right now, what we've seen this year, that the number of high-quality stocks, which is the core of our portfolio decisions, they came down indiscriminately together with the market. So we see opportunity to, upgrade the quality of the portfolio and hopefully benefit when, the fears would alleviate a little bit going forward.
Okay, thank you so much for coming here, Dmitry.
Thank you, Martin.
Good luck.
Thank you.